Hello, everyone. Thank you for joining us today for our first ever MPPL Financial Investment Webinar. We did some recent client surveys and heard from you that this was a topic you wanted to hear more about. And although we didn't plan it to be at such a volatile time in the market, here we are. So let's jump in. And we're going to be talking today about investing in uncertain times and kind of how MPPL defaults to this idea of process over politics. But before I get too far into it, I want you to realize there is a question and answer button on here. We will be answering questions at the end. So if you have questions, feel free to type them in the question and answer bar, and we will address them at the end. So without further ado, we will get going here. First, word from our lawyers, disclosures that have to be up here for a couple seconds. And now let's get into the agenda. So first of all, I'm going to do some introductions. We're then going to be talking about kind of the current topics that are on a lot of our investors and our clients' minds. We're then going to jump into the MPPL investment process and kind of how that actually plays out in reality, what we're watching as far as data goes, and then give the firm investment outlook on what we think is coming in the future. And as I mentioned earlier, we'll be following into a question and answer session at the end of that. And we will be recording this, so if you want to see a recording after to catch up on all our great information, we'll have that as well. So we'll start with introductions. For those of you who don't know me, my name is Scott Walschlager. I am the CEO of MPPL Financial, also one of our lead advisors here at the firm. With me today is Jesse Dunsmore. Jesse, you might not have met Jesse. Jesse works in the background a lot of times in our investment department. He is a graduate from the Honors Financial Markets program at the University of Minnesota Duluth, where they actually managed money for the university. That's where he got his start. He had a career in corporate finance before joining our firm. And for the last few years now, he has been our assistant portfolio manager, focusing on the research and fundamental side of our business. He's also passed the first 2 levels of his CFA, and he's now a CFA level 3 candidate, which is a very good designation to have when you're in the portfolio management world. So for those of you who don't know, that's Jesse. Now let's jump in. And we're going to focus today at the start of this meeting on what is on investors' minds. And we hear this time and time again when we're in meetings with clients. We also see it on the news. Really, this idea of politics and policy proposals is dominating the news coverage, is dominating the questions, and probably contributing to some of the volatility we've seen recently. But I want to hit something right off the bat here, right? We know politics are emotional, right? I would say even more so now than they have been in the past. But as a general rule, we do not want to let our emotions get in the way of making our investment decisions. There's probably a lot of data on this, but essentially letting our emotions run our investment decisions is never a great strategy. This chart, I think, shows something interesting. It comes from JP Morgan. And what they're showing on this chart is you can see when a Republican or Democrat won the presidency, and immediately how it changed how that party felt about the political and the economic landscape. But we have to appreciate that just because an election happened, it didn't change the economy overnight, right? And so we have to appreciate that how we feel, though, does impact how we spend, how we think about the markets. But really, for this discussion, we want to check our politics at the door and talk about what we really need to focus on. And so we're going to try to not make this about politics, although clearly there is some of that going on in the background. So what are investors watching today? Okay, well, you can see the list on the screen, but we have to appreciate that as we think about what investors are looking at, and each of these things on the list, there is some positive and potentially negative aspects of each one of these items. For many of these, we have to also appreciate that there is not enough data to actually make a good investment decision based on what is happening. A lot of this stuff is talk. A lot of this stuff is policy proposals, but we really have to wait and see what comes out in the text of bills, what actually happens, and then actually see some of the data that flows after it before we're willing to make investment decisions off of it. And I think that's a really important thing to think about here. So let's dive into a couple of these and a couple points I would make on each. So first of all, tax reform. We have to appreciate that when President Trump came into office, there was a sunsetting scheduled for the current Tax Cuts and Jobs Act, right? Which, if nothing is done, come next year, we will see higher taxes in general, both on individuals mostly, and in some case corporations. And in that situation, we can expect with higher taxes would come less economic growth. And I think that's a pretty straightforward connection, right? But if we can extend the Tax Cuts and Job Act, that will likely keep us at least going on the same trajectory. In addition to that, there's also been discussion around this president that they want to actually reform taxes and lower them further. And we have to appreciate that also has some positive impacts on economics, okay, and the profitability of corporations, but also how much money we as individuals have to spend and therefore the economic activity we generate. So we have to appreciate that these tax reform bills we're talking about, well, we have to see the data before we can make a good reaction to them. They are likely to be net positive in the near term. Now, we can always argue it might be negative in the long term because we have to appreciate that this country has a significant amount of debt. We're running fairly significant deficits, and this is something that Jesse is going to talk about later. So there is some long-term implications of tax reforms we have to be aware of, but I think, again, it's too early to tell, so we got to wait and see. Deregulation is another one that has been a hot topic for this administration, and we have to appreciate there is an untold cost for regulation. It's hard to put a finger on it. It's hard to pinpoint what the number is, but I know in our business and in a lot of other businesses we talk to, there is a cost to regulation. The question that is really hard to answer is that cost, right, worth the offset of getting rid of the regulation, which is the risk that it was put in there to mitigate? That's a really hard thing to say. And again, I think deregulation could be said in the short term as a positive. In the long term, it's possible it could be a negative, okay? But again, we got to wait and see. Tariffs is probably the biggest one driving the market in the near term. And I think with tariffs, this is a really tough one as well. On one side of this equation, the tariffs are getting put into place because we have massive trade deficits in this country. Many countries around the world have higher tariffs on goods than we have on their goods, and it's created some trade imbalances that are systematic that need to probably be addressed. We've also seen a lot of manufacturing businesses in the United States leave to other countries for lower cost of labor. And could the tariffs in some way bring some of those jobs back and help balance that out? Absolutely. But as they always say, the devil's in the details. So I think we got to see this play out before we can weigh in on this fully. But certainly the on again, off again tariff policy we've seen where we don't know what the tariff is going to be, when it's going to come on, when it's going to come off, that is creating an element of uncertainty in this economy that's really hard for businesses and individuals to plan around. And we're starting to see contracts come in from people we work with a lot of caveats and a lot of variable pricing. And I think when you have variability and you have uncertainty as it relates to outcomes, that can have a dampering effect on the economy. And so obviously with tariffs, it could bring some jobs back, it could bring some good news, but it's likely to create some inflation and some uncertainty, which is the uncertain piece, which is not good. So again, a little bit of both. We could spend a lot of time talking about geopolitics, but I'm going to skip past this one fairly quick, but just say that, when we have unsettling in the world, wars in Ukraine, wars in the Middle East, these are not good for economics, generally speaking. So if Trump has a way of making these things get tempered down, that might be a positive, but again, way too early to tell. And if we end up having a new conflict with Iran and their proxies, that could go a different direction. So I think, again, very similar story, too early to tell, but something we got to keep an eye on. Immigration, also a very hot topic these days, but we're in the early days of this. We have seen some deportations. Deportations in certain sectors of the economy, if there's large numbers, could have an economic impact that we have to be aware of. But I think the data is too early to tell. I think as a company, we agree or understand that we need legal immigration coming into this country because of our declining birth rates, because of our aging population. Unless something else changes, we are going to need more people in this country that are willing to work. And finding the right balance on that, I think, is really important. How it's going to affect the markets in the short term, obviously creating volatility today, but hard to know. And then DOGE as the last piece, right? I think a lot of people could agree that if we can create more efficiency in our government and less waste and fraud, those would be good things, right? I think when you look at the headlines, it's hard to parse out what is truth, what is real, what the numbers actually are, right? But those will eventually show up in budgets, right? And then there's the negative side of cuts, which is people are losing their jobs. Those people are, if they can't find a job, are going to lower spending. And in big enough numbers, it could have a negative economic consequence to it. But I think the uncertainty element is another factor that weighs on stocks a little bit. But I think given time for a lot of the items on this list, and Doge included, I think we have to appreciate that we will see that data over time. And if they can create efficiencies in the government and that results in lower deficit spending and lower future debt, I think that will be a net positive as long as we can deliver the services we need in this country. So I'm not going to spend much more time than that, but I think those are the things a lot of investors have been asking about. But I think the short answer to all of them is we got to wait and see how they play out before we're going to build those into our investment thesis in the moment. Okay. So what I want to talk about is our process. Okay. So MPPL's process, and I'm going to be real quick here because many people on this call are going to have worked with MPPL for a long time. You know our process, but we bring in new clients all the time. So I want to make sure we're on the same level playing field here. And our philosophy around managing money comes from a place of customization and personalization. We believe that every client has their own distinct needs, their own risk tolerance, and so we need to have that personalization. But we also have to appreciate that from a strategy level, can think of these as the building blocks of any client's portfolio. These are actually very consistent, and our investment team does a great job of creating consistency and quality in these strategies. And the short version here is, if we have a stock strategy and we really like Apple or we really like NVIDIA as a company, there's no reason we don't like that for everybody in the firm, every client who uses that stock strategy. But some clients may want that stock strategy and some clients might not. And that's where the portfolio comes in. And that's where your advisor is really your architect. And they take the building blocks of the strategies, they put them together to create a final custom portfolio design for you as an individual. And those things are customized based on our age, our time horizon, what we have for cash flow requirements, what is our tolerance for risk? Can we handle that roller coaster ride the stock market throws us on every once in a while? And what are your unique tax situations? Do we have to minimize taxes, or are we okay paying some capital gains? And that's where the customization really comes in. But a couple other main philosophical points about MPPL is we believe in this idea of proactive management versus, what we call buy and hold or stay the course approach. There's a lot of firms around this country who just say, we're not even going to try. We're just going to build a portfolio, allocate it across a lot of different sectors, diversify it, put on the blinders on, and hope it works out over the long run. And over long periods of time, I think that can work. But for retirees, for people who are in retirement who need risk mitigation, who need cash flows from their portfolio, we believe a proactive approach is actually the better approach. We believe in doing research and taking positions, and we'll talk about how that's actually worked out for our firm in the near term. Okay? We also believe in this idea of the independent and proprietary in-house research. It's the reason we have people like Jesse and Dan Wynn on our team, people who can take the time, do the research, and come up with unique ideas at our firm. We have our own proprietary models and algorithms, which we use to help digest the market and make decisions off of. We do research on individual companies, around the economy, around the world, and we make decisions based off that. But there's one example that I like to use, because in the world of buy and hold and no research, we've been led to believe, because it's been true for so long, that like small cap stocks, as an example, are going to outperform large cap stocks in the long run, but it comes at a cost, which is higher volatility. And it was so true for so long, people stopped questioning it. And our firm did it. Our firm actually did that research, and we came to a really shocking conclusion, which is that for the last 10 years, small cap indexes have actually underperformed large cap while having higher fees and more risk. So in the name of diversification, a lot of other firms are just throwing small cap indexes into their portfolios. We actually make conscious research to say, should we, and in what quantities? And that's just one of the many examples here. But I think sometimes it helps to show our action or our philosophy in action. And these are just two examples over the last few years that we've taken a position on based on our research and our in-house portfolio management that have really turned out to be a net positive for our client. One of them is underweighting international equities. Back in the early 2000s, most portfolio managers started to add a consistent amount of international equities to their portfolios. And since that time, a lot of money managers haven't even checked that and kept those pretty consistent. Yet, international has been underperforming the US stock market for a considerable amount of time. If we look at the last 10 years, the US has been outperforming foreign on many occasions, okay? But very specifically during the COVID policies of China, and again, this is not a public health decision, this is an economic decision. We knew having a zero COVID policy and shutting down the economy was not great for economics. So we made the call to underweight China in addition to the already underweighting we did of international. And then you look at just in the last 2 years, that has made a massive positive impact on the portfolios because of the underweighting China decision. Last year, we also remember hearing the news where they constantly talked about the impending recession. It was coming any day now. That was the topic of the day. Every news station had it. And our team had the guts to stay in the market. And that's because we had data showing that companies and individuals were actually in a pretty good spot. They had low debt, they had locked in low interest rates, and companies were growing earnings. And we felt like that was a recipe for a pretty good market. So while others were playing defense, we leaned into equities, even with the talk of recession imminent. And last year was a fantastic year because of that. And that's just 2 examples of the kind of stuff we do having independent research that I think is valuable to understand. So with that, now I'm going to turn it over to Jesse, and Jesse's going to focus on those things that we do pay attention to a lot closer, and that is the data and the outlook.
Okay, thanks, Scott. While we will research topical issues of the day, as Scott described, we want to avoid being influenced by the latest news cycle and by emotion in our investment decision-making. So we really strive to have a data-driven process for making objective decisions in our investments. So we will take a look at some of the key areas that we consistently look at and analyze data for that help inform our outlook. I'll hit the highlights on this slide, and then we'll dive into more detail and look at some of the data in each of these areas, and then summarize our outlook. So the first area is fiscal policy. Fiscal policy is just government spending and taxation. Currently, we're running large deficits. Running large deficits with government spending is actually stimulative to the economy. We are borrowing money and spending it, and that supports economic growth, though this is actually unsustainable in the long run. The next area is monetary policy. Monetary policy is the Federal Reserve, our central bank, and what they do with interest rates, what they do with the money supply, and currently with high interest rates, they're restrictive. We see room for the Federal Reserve to lower rates incrementally to be somewhat less restrictive than they have been. And then the next 2 areas are, we see fairly similar trends. We look at consumer spending, which drives around 2/3 of economic activity. And we also look at corporate earnings. Both of those we see slowing. We still see positive growth in consumer spending. We still see positive growth in corporate earnings, but we do see these areas slowing down. And then finally, we start to look at equity valuations relative to this backdrop with the consumer, corporates, and our fiscal and monetary policy. And currently, we have high valuations. That increases the risk that if growth comes in slower than expected, we could have a larger than normal correction. We're also currently seeing the technical picture with the price action in the market beginning to deteriorate to some extent. And then finally, we'll look at one of the key decisions that a lot of asset managers make, which is the allocation between equities or stocks and fixed income and bonds. Currently, we think the risk reward is pretty balanced, where it's whereas previously we would have advocated very heavily for equities in the near term. Now it looks more balanced, where we would recommend more fixed income in portfolios. Before we jump into the slides on the outlook, we want to look back at where we've been over the last few years. These charts show the annualized return over a 5-year period. So these are annual returns kind of on average over the last 5 years for each of these major asset classes. We have equities or stocks in blue, we have bonds in gray, and then below we break down the S&P 500 into each of its sectors and what the sector returns were. And so there's a couple of key lessons that we want to take away from this past performance. One, let's think of what has happened over this 5-year period that we earn these returns over. we talk about uncertainty and investing in uncertain times. Well, in this 5-year period, we had COVID, where the global economy was virtually shut down. That was followed by a reopening with a boom fueled by record amounts of stimulus, which resulted in some of the highest inflation that we've seen in decades, which was followed by some of the highest interest rates we've seen in decades, as well as war in Europe, war in the Middle East, and the emergence of artificial intelligence in the mainstream. So with all these things happening, there was a huge amount of uncertainty over this time period. Yet in the S&P 500 for large cap US stocks, you would earn an annualized return of 14.5% staying invested through these time periods. And the mid cap, small cap, international did okay. International underperformed domestic, but still very respectable returns. And over the same time period, with higher interest rates, long-term government bonds had a negative return. And what was driving the outperformance of the US large cap is really tech. So what's referred to as the Magnificent Seven was the highest performing sort of sector or category within large cap stocks. And that Mag 7 is your companies like Apple, Microsoft, NVIDIA, Google, Meta, Amazon, Tesla. And so the few lessons that we want to take away here are, one, with all the uncertainty, there were still great returns. Uncertainty is actually your friend. Uncertainty provides buying opportunities in the market where you can earn great returns over the long run. Two, bonds don't always equal safety. So we saw that over the 5-year period, you would have lost money on average each year in long-term government bonds. So not even corporate bonds. So when you hear people talk about, well, I'm more, of maybe a moderate or conservative risk level, and you get a static allocation of set bonds, that it doesn't always mean safety. That doesn't always mean for conservative clients, that's the right decision at a specific point in time. So it supports our thesis that doing research, doing analysis on the current environment, we can add value. The other key takeaway is the stocks that really outperformed the overall broad indexes, the technology companies. Over history, innovation has really driven increased productivity, which fuels economic growth, and the benefits accrue to those companies that are driving those innovations that improve productivity. So this is an area that we like a lot and we like going forward to, is any of those companies that are driving innovation, that are driving improvements in productivity for the economy. Now let's jump into some of the background in each of the areas we highlighted previously and start forming our outlook. First, we'll talk about fiscal policy. The chart on the left here in blue, this just shows the receipts of the US government, so basically the income of the US government. And on the right, we have the expenditures of the US government, where all the money is going, what we're spending it on. So what we want to highlight first is income of the US government in 2024 was primarily from individual income taxes down here and payroll taxes, and amounted to $5 trillion. So again, that's 5 trillion with a T. Our spending was just under $7 trillion. So we are spending more than we're bringing in taxes, to the tune of approximately a $1.8 trillion deficit. And that's annual. Each year, we are spending 1.8 trillion more than we're bringing in taxes. And what are we spending the money on? The first large category is kind of entitlement programs, I'll call it. And that's really Social Security, Medicare, Medicaid. So primarily redistributing those income tax dollars to these programs to support citizens. So that is the largest category of spending, at nearly half the spending in the US government. Then we get into more typical kind of categories that you would think of. Defense spending is a large category at almost $1 trillion. And then non-defense spending is really just running all the different departments in the government at about $1 trillion. And then the last category is interest payments. And for the first time in 2024, the interest payments on US government debt exceeded defense spending. That's not a good sign. So this deficit spending has led to a buildup of debt where now the interest payments are larger than our defense spending. So what is it going to take to correct this, and what are potential implications? Well, you need to either increase taxes or you need to cut spending. Many of these programs aren't very discretionary. Yes, there's probably some fraud, waste, and abuse in some of these programs, but $1.8 trillion is a massive number. So unlikely that there's 1.8 trillion of cuts that can come from these programs. So we'll probably need some combination of higher taxes, lower spending, and lastly, if we can get more economic growth, that increases the tax base and increases tax revenue without raising tax rates. So that's what it would take. Some of the longer term implications, we'll look at the amount of debt that is built up now from this deficit spending. So the first chart here shows the amount of borrowing annually, and the second chart shows the amount of debt that is built up. Both of these are relative to GDP as a measure. That's kind of the important measure, is how large is the deficit spending and the borrowing compared to the size of the economy. So the first point is deficit spending is not new. This chart goes back to the 70s. So we go from 1970 all the way through current. And we see that on average, our deficit spending has been negative 5% of GDP. And it'll cycle around that number. We've had some periods during the late 90s, 2000s, where we actually ran budget surpluses instead of deficits. And then there'll be certain times where we have very large budget deficits. This was the financial crisis, where there's a lot of stimulus in order to support the economy during a crisis. Same thing during COVID. There were massive amounts of stimulus in order to support the economy. And this is basically each year borrowing money. And what that's resulted in is a buildup in the amount of debt outstanding to the point where we are now at 120% of GDP. So the amount of debt that the US government owes exceeds the annual output of the economy in the US by 120% or 1.2 times. And what is concerning still is that today we are deficit spending greater than negative 5% of GDP, even though we're at full employment. Even though the economy has been good, we continue to deficit spend at record levels, which continues to fuel a buildup in debt. And so it's not sustainable in the long run. And so what this means is at some point we'll have to cut spending, government spending. And as we noted earlier, government spending is supportive of economic activity. So when it comes time to cut spending or raise taxes, that will slow the economy. And the other thing to keep in mind is as debt builds up and as we continue to spend more than we're bringing in, if you're out there buying 20 and 30-year government bonds, at some point, the people that are buying bonds will ask themselves, how is the US government going to pay these bonds back? And the answer may not be, what the bond investor is hoping for. And so there may be some risk in those long-term government bonds. The next area that we'll talk about briefly is monetary policy. Again, this is the central bank, the Federal Reserve, controlling interest rates in order to target stable prices, which is low inflation, and target full employment, which is low unemployment. So this chart shows core PCE in the black over time, going back to the 90s. Core PCE is one of the Federal Reserve's favorite measures of inflation. It is the personal consumption expenditures index. It's similar to, like, you'll hear of CPI or PPI. It's similar to those, but it's a measure that the Fed likes to look at. And it's been relatively stable at kind of 1 to 3% inflation over time. And we saw that after reopening the economy and with all the stimulus post-COVID, we ran inflation rates that were higher than we've seen in decades. Today, inflation has slowed back down for PCE, where it's growing at just under 3% annually. The Fed targets more like 2%. So this is a rate that's still elevated, but isn't as high as we've seen. So we've got quite a bit of progress on inflation. the last remaining components of inflation that are above average is in housing. So the housing market has still stayed fairly tight. Prices have continued to climb, and that has continued to fuel this inflation number. We expect that to improve over time slowly, and inflation to continue to improve slowly at lower and lower rates. And we think that will give room for the Fed to continue to lower rates slowly over time. So the blue line shows the federal funds rate, which is the short-term interest rate that the Federal Reserve controls in order to target inflation. One thing that we've seen a pattern emerge over time, you'll notice around 2000 when the Fed raises interest rates, the gray shading represents a recession. When the Fed raised interest rates around 2007, 2008, we got a recession. When the Fed raised interest rates from very low levels back in 2018, 2019, we had a recession. This one was a bit of an outlier, given that it was more associated with COVID rather than, say, the financial crisis or the tech bubble. But we are at the point now where we've had high interest rates, we're beginning to lower them. The pattern would show potential for recession. This is one area where we've looked deeper into the data. Both the consumer and companies have done a great job of managing debt levels. So the consumer has refinanced mortgages at very low rates, locking in 30-year fixed rate mortgages, and companies have refinanced and paid down debt, issuing fixed rate bonds. And both households and companies have put themselves in a very good position where higher interest rates haven't had the large negative impact they've had in past cycles. So that is the good news. Interest rates will still slow the economy, high interest rates, but these actions taken by households and companies have very much mitigated the effects of high interest rates, where we think there's a lower chance of a recession during this period, or if there is a recession, it will be fairly mild, not like a financial crisis that we had in past cycles. Now, turning to the consumer again accounts for roughly 2/3 of economic activity, so is critical to understand the state of the consumer. So the key question is, can the consumer spend? And what determines whether the consumer can spend? First will be employment. So can you get a job? Basically, is everyone that wants to have a job, can they have a job? And the second is, those that have jobs, are they earning more? So are you getting wage increases? So first, on the employment side, prior to COVID, employment was growing at the kind of 1% to 2% rate annually. Obviously, when the economy shut down, employment contracted, and then on the reopening, it boomed, and we've since slowed back down employment growth to around 1% to 2% again. So we're kind of back into a normal range. Similarly, for unemployment in the red, when the economy shut down, unemployment spiked. Reopening, we've since come back down into a normal range. And for job openings, those jobs that are posted, that are open for hiring, after the economy reopened, that number increased significantly, the number of job openings, as there were labor shortages and people were looking to rehire. And that has since slowed back down to a more normal range for growth. So where we sit today is the number of job openings relative to the number of employees and the number of unemployed people relative to the number of all employees are both around 4% to 5%, so largely in balance. So there are a similar amount of job openings as there are a similar number of people looking for jobs. So labor market is largely back into balance. The rate of employment growth has slowed back down to normal. So we still see positive growth there, but at a slower rate, more typical of what we saw prior to COVID. On the earnings side, earnings pre-COVID were kind of in that 3% range annually for wage increases. That increased quite a bit, obviously, through COVID and labor shortages, but that has since returned back to a little bit above average level at around 4% on average annually. And this is more, we think, due to the higher rate of inflation that we're seeing currently. requiring employers to give a little bit larger than what is typical wage increases that we saw back here. But the current rate largely keeping up with inflation. So what we have is low but stable employment growth, a labor market back in balance, and we have wage growth that supports spending. So we think the consumer will continue to grow their spending, but at a very slow rate, like we saw more in that 2017, 2018 timeframe. And we think that the aging population that we have, lower population growth, will continue to keep the labor market in balance or tight, which will continue to support the wage growth that we're seeing and continue to support consumer spending. So that's sort of the good news, is it's stable, low growth. We are seeing signs of stress, though, in the consumer. This chart shows credit card delinquency rates. So the percentage of the loans outstanding that are behind, or, people are, you're supposed to pay off your credit card within 30 days. If not, you incur interest. So this is the percentage of loans that are exceeding 30 days where they're behind on payment. Currently, we had, all-time lows in delinquencies with all the stimulus. That has now risen as the stimulus has worn off, and we are at delinquency rates that we've not seen in over a decade. The last time we saw credit card delinquency rates this high was back around 2011. That sounds bad on its face, but if we look further back in history, we see that a normal range for credit card delinquencies would be in the 3 to 5% range. So this is still a very low number historically. We see a very similar picture on bankruptcies as well, where bankruptcies are beginning to rise again, but are still low historically. So what that tells us is we have a fairly decent job market, but we're seeing that people are spending at pretty high rates where they've had to use their credit cards and are getting behind on some of their credit card payments. So we see consumer spending, again, slowing, and maybe slowing a bit more than people expect, but still staying positive. And we're seeing a similar picture on the corporate side. So this chart shows sales or revenue growth. The dark blue line is the revenues of the companies in the S&P 500. And the light blue line shows the growth rate as a percentage year over year. And what we're seeing is we still see positive revenue and sales growth, but we're seeing that slow down. So after COVID, with the reopening, with the booming economy, we had revenue and sales growth rates that were exceeding 15%, which was just phenomenal, kind of all-time highs. Since that time, we've had the growth rate slow down to about average of around 5%. So we still see this is still a very healthy level of growth, but it's since slowed down. And this growth is primarily being supported by technology companies and communication services and financials within the S&P 500. We are seeing the other sectors slowing down to below average rates. So it does indicate to us that while we still have overall healthy sales growth, that there's a broader based slowdown that's occurring. We still see positive growth, but again, slowing. And with that backdrop of a slowing consumer, a slowing growth in revenues and earnings, and kind of a mixed picture between the fiscal policy, the government spending, and the monetary policy, the interest rates, there are high valuations in stocks. So in the S&P 500, this is the PE ratio, is at near all-time highs currently. We've seen these kind of peak levels kind of post-COVID during the boom times and back during the tech bubble. So it is an indicator that valuations are very high. When we see high valuations, what that tells us is that the market expects a lot of growth. So you're willing to pay more if you're going to get a lot of growth. So the market is expecting a lot of growth and is willing to pay for it. What we need to be concerned about, or what we need to watch, is we just talked about a backdrop with slowing growth in the consumer, slowing growth in companies, and potentially some headwinds from spending cuts with the government, but also being supported by potentially lower interest rates. So if growth comes in slower than expected, these valuations may not be warranted, and you could see there could be more risk of a pullback in stocks or a correction in stocks. So starting to put it together, we want to talk a bit about the risk reward between the two major asset classes of stocks or equities and bonds. So we'll look at stock returns over here on the left side, and we'll look at bond returns on the right side. So for the S&P 500, this bar represents the total return in the S&P 500 in 2023. This bar represents 2024. So in 2023, we had 26.3% total return. In 2024, we had a 25% total return. 2 back-to-back years of over 20% growth in the S&P 500 was phenomenal. Typically, you more see a 10% rate of return for the S&P 500 on average over the long run. We can kind of break these components down to understand them better, to know what's driving those returns. So first is dividend return, generally the smallest component. Your dividend yield on your stocks gives you some return of cash. The second component is earnings growth. So the underlying earnings of the company growing accounts for some percentage of that return. And we see here that's been about 10% on average, more like 6-7%. The final component is multiple expansion or valuation expansion at nearly half of these total returns, in excess of 12% annually. This multiple expansion represents those higher valuations. So this kind of simple analogy I like to use is, think of if you have a rental property, you have a house that you're renting out. The dividend return would be like the rent that you're getting each year. The earnings growth would be like your ability to raise the rental rates to earn more. And then this multiple expansion is equivalent to buyers in the market being willing to pay you more for your house. So kind of that price growth in your house. So we see from stocks that the total return over the last couple of years was about half from that actual earnings and earnings growth, and about half was just from people willing to pay more for stocks. And that's where those high valuations cause us a bit of concern. More typically, you'll get a couple percent in dividends. You may get a little bit of multiple expansion, but not much. And you'll have good earnings growth over time. If we expect a slower growth environment to maybe be a little lower than the 6 to 7%, and we have a starting dividend return that's just a little bit lower than 2, and with the high valuations, pretty tough to expect any multiple expansion, we think returns over the next couple of years for stocks will be closer to this average number of 10% or even less. It might be more like that 5-6% range over the next couple of years. So that's on the stock side. We think we're closer to average or a little below average in the short term. On the bond side over here, bonds go up in value when interest rates go down. So if interest rates go down, the blue bars show you the amount you'll get for a return on bonds. If interest rates go up, the price of bonds goes down. And so the red bars show you that if interest rates go up, what's the return you would get on government bonds. The area that we're focused on is these 1 to 3 year Treasury bonds and 3 to 7 year Treasury bonds. If interest rates go down, you could get up to a 6% return on just a 1 to 3 year Treasury bond. Or if you're in the 3 to 7 year Treasury bonds, you could get almost an 8% return if interest rates go down. If interest rates go up, you might get a 2% return, which is a low return, but you're not going to lose anything on your 1 to 3 year Treasury bonds. And on the 3 to 7 year, if interest rates go up, you'd basically be flat. You'd earn no return whatsoever, but you're not going to really lose anything. And we think there's a fairly low chance that interest rates go up or go up by as much as 1%. So if we look at 1 to 7 year Treasury bonds, we could earn 6 to 8% with very little downside in kind of a worst case scenario. If we compare that to what we were looking at for stocks, where we could be 10% or less, and let's say we even go into a recession, you might have a negative return in stocks. We think the risk reward looks pretty good for taking on more fixed income in your portfolios in those kind of short to medium duration bonds, those kind of 1 to 7 year government bonds. So going forward, in the near term, we're looking at taking a more balanced approach to portfolio allocations for clients between equities and between bonds. So lastly, kind of as we do in a lot of our presentations, we try and summarize kind of just key highlights. Money market for cash is still very attractive. You may have noticed on that last slide, in short-term bonds, which is what money market is, you can still get over 4% on your cash, which is the place to be, rather than in a savings account in a bank earning much less than that. And on the bond side, we think short to medium term treasuries look pretty good, as well as high quality corporate bonds that will perform similar to treasuries. We think that's an attractive area to be, especially if you're more conservative. We think stocks are still attractive in the long term, but short to medium term, over the next couple of years, we want to moderate our expectations. We don't think we're going to get that as back-to-back 20% years, but we still think long term will be good. Long term, we've got growing world population, increasing labor productivity, which is positive for stocks in the long run. And the main risk that we're monitoring, as we pointed out, the fiscal situation with the large deficits and the high amount of government debt we're running is concerning. In the past, we had like financial crisis where both households and companies and banks were borrowing too much, leveraging up too much. That's not really an issue today. The issue is more the U.S. government seems to be borrowing too much. So that's the main risk we're monitoring. Turn it back over to you, Scott.
All right. Thanks, Jesse. Appreciate that. So as we finalize today, we're going to jump into the question and answer section. It appears we got a few questions that have already been put to us here. So I'm going to, Jesse, give you a break. It looks like there's a few here that are up your alley, but one that I think I can tackle pretty handily here. So maybe I'll start and then I'll pass a couple to you. And if there's anybody out in the audience that wants to ask a question, now would be the time to start putting those in and we'll get to them. So the first one I'll hit just to get us started off. There's a comment that says they're concerned about long-term capital gain taxes given the run-up in the markets and how they should financially plan. They hate surprises, and what role does the financial advisor play in helping on this front? So I think the capital gains thing is an interesting one. Nobody likes paying taxes. Nobody likes going to your accountant this time of year and getting surprised by a tax bill, right? That's not the fun part. But I think we do have to appreciate a little bit that if we're paying capital gains, it's because we made money. And if somebody offered you, $80 or $100, but you had to give them 20 back, would you take the 80 if you lost 20? I think most people would say, of course you would. That'd be crazy not to, right? Well, I think we have to think about capital gains in the same way. Yes, it's no fun paying taxes, but the only reason you're paying them is because you made money. Even for people who are at the highest tax rates, the worst case scenario you're paying on the federal side is like 24% capital gains taxes on the long-term stuff. So I just believe that, we have to think of long-term capital gains and capital gains in general as a good thing, although we don't love paying them. But this is where, like, as a firm, we really try to hold our stocks for 12 months in a day so we can get that long-term treatment versus short-term. We really try to buy companies that pay qualified dividends over ordinary dividends because, again, they're taxed at preferential rates. So we do some stuff in our investment team to try to minimize those. The financial advisor is a key part, though, making sure the right type of investments are in the right type of an account to control costs. But even if you do everything right, sometimes there's just no way to avoid this. And we see people who sometimes put money into annuities just because they don't want to pay taxes, but then you pay ordinary income taxes on the growth of an annuity later. So I think capital gains is one of those necessary evils. There are things that we can do to try to mitigate them, but we kind of talk about it not letting the tax tail wag the dog, right? That's kind of the idea here. We don't want to make investment decisions that are 100% focused on taxes. We want to make good investment decisions with tax mitigation being the secondary goal. But I would say if you have specific tax concerns or you're trying to keep capital gains or total income under a certain bracket, that is where your financial advisor is probably really great at doing that. So now I'll kind of pass one to you, Jesse. They're asking about AI. I mean, it's been the hot topic of the day. They want to know how AI is driving the economy and markets over the long term specifically is what they're asking.
Gotcha. Yeah, with any of these, there's a lot of hype, and it takes, quite a bit of effort, especially initially, to separate what is hype versus what is going to be the actual reality in the long run. I like to kind of frame it and start thinking about it first from a kind of an economic growth perspective when it comes to AI. So there's a very simple equation for estimating economic growth, and that is just the growth in the labor force, or the number of people that are working. So the growth in the number of people working and the growth in the productivity of those people. Okay, and AI at this stage really comes into the growth and the productivity of the people that are working. And we've initially seen where AI has been kind of a tool that's sort of neat to work with, fun to work with. It isn't maybe applicable to everything that everybody's doing here today. But it is very useful in a number of areas. Anytime you have repetitive tasks that relate to like data entry, content creation, doing any type of research, or like coding, writing code for software, customer service, all those kind of applications and use cases, you're going to see as early areas that AI is implemented in order to increase productivity of the labor force, which will help growth. In the longer run, we'll be looking for AI to begin moving into more specific applications that are more complex areas that it maybe isn't tailored to today. Things that take a little bit more discretion for people to do. AI over the longer run will be trained to do some of those things, and will be able to increase productivity growth in the economy. Long run, you'll get into things like robotics, which then start to affect that labor force growth side of that equation, where you can start to do more even without people. And we think that'll happen, but that's a ways down the road. So for now, we're looking at more, what are the specific applications where there's a lot of repetition going on, content creation, data analysis, aggregating research that AI can apply to. And so I think we'll see more and more of the reality of what AI will do that will come forward in the next few years. And more of those longer term winners will become evident versus maybe some of the short term companies that have kind of a cool product today, but maybe not really improving productivity.
Excellent. Thanks, Jesse. I might just add a couple tidbits to that, because I do think this country, as some other countries around the world have faced, when you have an aging workforce and a declining birth rate, especially if you don't have immigration to offset that, that can actually lead to economic stagnation, kind of what you were referring to, right? And if AI and robotics can replace some of that lost productivity, we actually have a chance to grow the economy in a declining workforce environment, which could offset some of the risks of having that declining birth rate and that aging population, which, you never quite know how something this big is going to change the world or change the economy, right? But that has some real interesting applications given the world we live in with those facts. So I think it'll be interesting to see where it goes, but to dovetail off what kind of you said there. So there is a question here. Somebody just asked, are you planning to rely on more individual bonds or bond ETFs going forward? So I think that's probably a good one for you to tackle.
Yeah, good question. We have multiple strategies, right? So we have a fixed income funds strategy where we're using all bond ETFs. We also have the fixed income strategy where it is all individual bonds. So really that's kind of more discussion with your advisor on which strategy is appropriate for you and what you're trying to accomplish. So we will continue to offer both. We'll continue to have individual bonds and bond ETFs. We are using bond ETFs a little more in some of our strategies, like the funnel where applicable. There are more and more bond ETF strategies that are very low cost and provide good liquidity that we've implemented and are using. So as new products come out that are, after we've done the research, appear to be safe, good liquidity, low cost, we will use them and work them into portfolios, but we'll still be using both bond ETFs and individual bonds going forward.
Thanks, Jesse. And I would add to that too, in a world when we have really low interest rates, the opportunity for higher rates is very real. And so bond funds can be more risky. So we tend as advisors to think about individual bonds when we're at low rates with the potential for rates going higher, because you can mitigate some of that interest rate movement risk on an individual bond that you can't sometimes do on a bond fund, right? But when we're sitting here at really high rates, and the odds of rates coming down are better than rates going up, I think it becomes maybe less crucial to use individual bonds versus bond funds. But that's, again, something that the team on our investment side is looking at regularly, giving advice to our advisors, and something our advisors are looking at for our clients. And so I think that use of individuals versus ETFs will ebb and flow naturally over time. But I think a lot of it is, to Jesse's point, specific use cases of when one works better than the other. So, all right, there is a question about the historical run-up in stocks. Specifically, they refer to tech stocks, Jesse. And they're wondering our strategies and how we manage that. And specifically, like if clients have a concentration risk, too much in one stock, what should they think about doing?
Got it. Yeah, there's been quite a bit of discussion over like concentration risk in the S&P 500. You'll watch any kind of business show at some point, that topic will come up. Currently, the S&P 500, some of the top companies will be up to 6 to 7% of the total market cap of that index. So getting fairly concentrated at that high level. Currently, our stock portfolios, we're at 4% or less for our largest positions. And we've trimmed those back down. So we're running significantly less concentration than even your main indexes. There will be times where we will let positions run when they're performing well, up to 6 or 7%, or maybe even just a little bit more for a period of time. But generally, when we have a position that has been performing that well, that they become that large, we want to let it run for a little bit. But then we start looking at the valuation and the outlook, and we start watching the technicals closely, and we'll begin to trim those positions back. And that's what we've done over the last couple of years as some of those stocks, NVIDIA especially, when they've just been running and becoming a larger and larger percentage of the portfolios, we've been harvesting some of those gains, locking in those gains, and reducing the risk in the portfolio by reducing the concentration in some of those positions. So it's really kind of a win-win where your index may get overly concentrated. We'll be trimming those positions back when appropriate to lock in the gains and reduce risk for portfolios. So in a few cases as well, if there's a client that has a very large concentrated position that's kind of outside of our stock strategies, we also have a couple techniques that we'll use with options in order to protect the downside, provide some downside protection in case of a major pullback that does limit the upside a little bit. But we have techniques with options to manage some very large outsized positions that we've used recently.
Yeah, and I think that's a really good point. For some of our clients who are corporate executives of large company, they can have significant stock-based compensation in their employer stock, and they may have restrictions on the ability to sell it, or they may be getting constantly new stock options and grants. And so using some of those sophisticated option strategies Jesse's talking about so that they can hold the position without having that oversized position have too much risk on the downside. I think that's a really important thing. So for people who might find themselves in that situation, those are really custom. Those are things we can't roll out across large client bases, but we do build individual customized strategies to deal with that. And that's something that Jesse and the team have done really well. So I appreciate that, Jesse. All right, so we have about 1 minute left and we have one more question. So I think this is perfect. So this question talks about reading a lot about international markets being the place to be. It says, what is your view about these opportunities, given that it sounds like we haven't invested much internationally recently?
Yeah, so actually recently we've ratcheted up our international exposure a bit, but we were underweight international. International, you can categorize in kind of two main buckets. One is developed international, think of developed economies in Europe, Japan, and the other is like emerging economies. So there you can think of like the Brazil, Russia, India, China, the BRICS. Um, and they each have a different outlook. The developed international, you have kind of a similar picture to the US. We have aging populations, high debt levels, but maybe lower innovation and growth, higher energy prices, and burdensome regulatory frameworks. But there are stimulus programs that are being implemented, especially in Germany, to increase spending, and there are low valuations. So we have increased our exposure some to international. Our broad-based, diversified strategies like tactical and strategic, those have fairly large international components to them, and very diversified components to them. Whereas our individual stock strategies, we handle a little bit different. So for our individual stock strategies, there are two ways that we gain international exposure. One is we have US companies who have international sales. So if there's growth globally, those companies benefit. So we have international exposure while still owning US domestic leading companies. And many of the leading companies in the world are based in the US, so there isn't much of a reason to look outside the US. The other way that we gain some international exposure in our individual stock strategies is not by going and buying leading companies on other stock exchanges and having to worry about currency conversion. The US, as I said, is the largest financial markets. We have international companies that list on US exchanges. So a couple examples would be like Taiwan Semiconductor, the leading semiconductor foundry in the world, is listed on a US exchange. We have it in our portfolios. Another would be like ASML, who produces lithography machines to produce the most advanced semiconductor chips in the world. They are listed on a US exchange, and we hold that in our portfolios. So we don't really always have to go outside of US exchanges and worry about currency conversion and risk in other countries to get that international exposure. We can hold many phenomenal US companies, hold many phenomenal international companies that are listed right here in the US.
Excellent. Thanks, Jesse. And we are out of time. We had one more question, but we can probably circle back on that at another event. But at this point, I would like to thank everybody who joined us today. This is the first one. Hopefully you enjoyed it. We'd love your feedback, but we look forward to doing more of these in the future. And so hope you can join us again. Take care.